this is the worst looking hat I ever saw. Well, you buy a hat like this, I'll bet you get a free bowl of soup, huh?
We are back. So listen to the Real Side on GCN Live. Always a pleasure to have you with me. 855-REAL-JOE, 855-732-5563. Let's get right to it. Let's get to know about your finances, what's going on with David Fischer. Remember him? I always love when this guy's on with me. I appreciate his time. I appreciate the way he lays things out for us. David Fischer, CEO of Landmark Capital, joins me as he does every week to give us a feel of what's going on in the market, what's going on with your money, what's going on with my money, and other things of financial. David, thanks for being with me.
Are you referring to your money that you give to the government and what they do with our money? Is that what you're
that's right.
To?
Last week was tax week.
That's a whole other topic.
That was
talk about that a little bit
my
today,
CPA said, okay, you need to pay. I went, what? I don't even have that much money in the bank. What are they getting that number?
The uncle needs it desperately. Sam wants to spend it, too, more than you give him.
I know. Just an insatiable appetite. Almost like a drug addict looking for more to eat. Just amazing. Hey, yesterday the stock market, right, it just tumbled. I mean, took a nosedive, as we like to say, hundreds of points. And what caused this? What is causing this roller coaster ride that's going on in the market?
Well, I don't think we're done. And I said, on your program earlier in the year, this year is going to be different than last year. We're going to have a very volatile roller coaster type of ride. And certainly yesterday was very indicative of that. I was on friends of yours, in fact, their national radio program, several of them on Monday. And I said on Monday, this week is a very important week, and next week also, where we have major earnings coming out for a huge number. 80% of the corporations are going to report earnings this week and next week. And I said this is going to be a key for the stock market based upon as rates are going higher because the Fed is raising rates, it makes it more difficult for companies to produce earnings because it costs more for business. So in this environment, this report is going to be very key. And I said, so watch. If the report is good, more than likely we'll see the stocks go up. If the report is good, but Wall Street wanted to, the market, people who investors think that they should have had better earnings, you could see the market tumble. If the report is not good, then you're going to see the market make several hundreds of points down. And I said, but this is really going to be based upon what the 10-year note, the 10-year yield, is doing, which I said once it moves above 3%, when that happens, you will see the market tumble hundreds of points, in my opinion. I said on Monday, you could see that happen on Tuesday or sometime during this week, if not this week, possibly next week, but I think it'll be much sooner than later. I think it could happen any day now. What happened yesterday? Not to toot my own horn, exactly that. The CFO from Caterpillar talked about earnings, and he said we had peak earnings, which meant the market interpreted, now they're trying to regurgitate saying he really didn't say it this way, but what he, in my opinion, and many analysts' opinion, he's saying earnings have reached their highest peak. And because of that, the 10-year yield shot up right above 3%.
But for those of us who don't understand financial terms, when you say they reached the highest peak this year for the value of the company, what does that actually mean?
In reference to the value of the company, earnings are at the highest level, and they probably won't. They've hit the ceiling. In other words, we're not going to keep going higher. Last year, earnings just went up, and people got a little bit greedy. They were much higher than they were in 2016 when the earnings report came out. And so people were anticipating, well, if that happened in 2017, now we have tax cuts happening in 2018, earnings should be higher because companies will make more money. Well, that sounds all good in theory, but there comes a time when things are overly zealous and euphoric and the market is overheated and earnings are overly hot that you can't sustain. They're not sustainable, and you have to come back to reality where normal earnings are, and that's what in essence is starting to be said right now. And it started yesterday, and the market didn't like it. It got spooked, and that's where interest rates. That's where the yield of the 10-year yield went above 3%, and the Dow dropped over 600 points, and on 424, it closed down 424 points. So that was kind of a magical thing at the time, I thought. But, there's this tug of war that is happening between earnings and higher interest rates, and I said it was going to happen. This is going to be a problem eventually. Now we're moving forward, and the ironic thing is that the Fed, Jerome Powell, he's what you call data-driven. He's not market-driven. Janet Yellen and Ben Bernanke, Joe, were market-driven. If the market got spooked, they didn't say or raise any rates, and they were so overly cautious to get to what we call normalized rates.
Right.
Jerome Powell is not that way. In fact, his last testimony before Congress, he said if the market corrects, I'm paraphrasing, then the market's correct. That's the job of a market. All markets go through that. It's not the job of the Fed to keep the market from not correcting. So he is data-driven, and data-driven is when the economy grows at greater than 2% and is starting to show some signs of overheating, being inflationary. That's when they need to raise rates to cool this thing down. So there's a 90% chance of a rate hike in June. We already had one earlier this year in January. There's a 62% rate hike in September and a 34% rate hike happening in December. As we get closer to December, that fourth rate hike that's kind of questionable might be more realistic, and we either won't have it or we will have it, but it's now kind of in question. But I think we're going to be on a multiple rate hike environment as the Fed pulls away the punch bowl, the drug, the cheap money that has driven this market in euphoric. And I'm not an anti-market. I'm just saying it's not normal to have this environment, and that's why we had such an incredible market last year, and that's not normal to expect that every year.
Yeah. No, I have been watching this stuff for a couple of years. I don't know a whole bunch about it. I've been paying more attention since you've been on the show and talking about how the effect of the whole thing. People don't realize that the chain that's connected to all these different things. Whether you have stock in Caterpillar or not, you might have stocks in other things. And when that market takes a nosedive like that, it affects everyone. We're going to go for a break, but I'm going to use the R word. Are we going to move into a recession this year? I mean, I've been hearing about a recession for a while. That's why I said to you once before. Everybody seems to be on a different page as to how finances roll in this country. We'll talk more about that on the other side of the break. I always appreciate the time that David spends with us, and I jokingly say I love the way he speaks in placeable English when it comes to finance. Unlike me, who can't find English words to save his butt. Anyway, we'll be back more with David at the other side of the break. Yeah, we're talking recession, but when? And what does it mean to you? I'm Joe Messina, your host. Listen to The Real Side. Do you have an American flag that was made everywhere else but America? Joe Messina here, host of the Real Side Radio Show. I'm always asking you to buy. We are back. You listen to The Real Side on GCN Live. Always a pleasure to have you with me. 855-REAL-JOE, 855-732-5563. And I really do appreciate the time that you're spending with us on the air, in the chat room, texting and tweeting, and just being part of the conversation. Where is your money? I can't steal that one line. What is it? What's in your wallet? We're back, and I'm back with one of my favorite people on the show. David Fischer joins us, CEO of Landmark Capital, and every week he gives us an update on the finances, on the market, on what's going on in your, I hate to steal a term from a commercial, but what's going on in your wallet, if you would, and what's going on in the tin cans with the cash buried in the backyard. David, thanks so much for being with me today.
I'm very thankful to be partnering with you and helping people understand what the environment is currently and where I think we're headed.
Uh-oh. And that was that R word that I used in the last segment. I mean, I haven't heard this. I'm a 70s kid. I remember the gas lines. I remember, milk was like, I think, $35 a gallon or something. It was just crazy stuff going on. But, are we looking at a recession? And what does that mean to us today in 2018?
Well, when I've been on your program last year, I said we're going to be on bull market in stocks, a bull market in gold. We're going to have a great economy, a lot of ability to make money. That's what I was talking about, because that's what I saw was happening, and that's what did happen. I don't see that environment now. I see us moving towards we talk about a 4-letter word. This is a 9-digit word, and this is not something people want to hear, but the reality is we are moving there. It's not happening next week, next month. Might happen next year, but I think will happen for sure by 2020. Let's take myself out of this for a second. Let's go to a recent survey that came out by J.P. Morgan Private Bank's Spring Investment Barometer that was released last week. It polls 700 people, the ultra richest people from around the world, net worth of liquid holdings, just their liquid holdings, money in the bank doing nothing, cash, $30 million or more. So that's a pretty ultra-rich type of person. Those people said, 75% of them in the survey said, we will have a recession in the next 2 years. So the big money who makes money by watching money says it ain't going to be good next year or the year after. Specifically, the poll said that 19% said it's going to happen in 2019, or 21% said that, and over 50% said it's going to be in 2020. So around 75% first year is when it's going to happen. They're not the only ones. Equity investors that are very well known, famous ones, just the article came out today, and we'll quickly mention some of these people. We've talked a little bit about some of them before. David Stockman, he was with President Reagan as the former budget director under the White House with Reagan. He's saying it's imminent. We will have a doozy of a one. It's exactly what he says, and it says it's just around the bend. But I think he's very aggressive in his opinion. But he says that we're have an epic monetary and fiscal policy collision getting ready to happen. We're just not paying attention to our debt. And I agree with him what he's saying. Scott Minard, he's a global chief investment officer for Guggenheim Partners. He said that it's going to happen in 2019. The markets are potentially on a collision course for disaster, quote unquote. He says we're going to have a recession, definitely. Paul Tudor Jones, I quoted him before. He's the famous guy for founding the Tudor Group. He doesn't talk much in the news very historically, but he came out in 1987, predicted the Black Monday crash, and he was right in October when that happened. One of the only people that predicted that. He's saying this recession will happen as soon as next year. He says, quote, we're replaying an age-old storyline of financial bubbles that has been played many times before. I have a white paper called Which Bubble Will Burst. So, I'm getting some of his data, and I put it in a white paper. But he said, we have the strongest economy in 40 years, full unemployment. The moon is euphoric, but it is unsustainable and comes with such costs as these bubbles in stocks and credit will burst. He's referring to debt there because we're not taking care of our debt. We'll go into that in a second. Ray Diallo, a couple more. 2020, he says, we're in the pre-bubble stage right now, and that's what you're seeing, reflections in the market. He says there's a 70% chance we will have a recession before the next presidential election. Kind of interesting how he says that.
Okay.
And he's saying this is going to be greater than the 60% order of a market loss. So this is going to be a bigger loss than what we had in 2008.
I think about what you're saying. This is going to be, a recession. But this is not. I won't say this is normal. I don't want to say it that way. You and I have talked about this, the roller coaster ride in the market, what the Feds are doing. Does this all kind of follow financial guidelines? How would we have stopped a recession from happening? And it didn't happen over the last 16 months, right?
Well, here's the problem. They never really fixed things in 2008. They never really let it reset. The Fed came in and propped it up, unfortunately. So it was, thinking, in the short term, which is how we think as Americans. Unfortunately, we don't think long term because look what our debt's doing right now. It's ballooning like crazy. Yep. We should be getting our debt down. That's a whole other thing we'll talk about if we have time here. The debt structure, and I got some numbers that's going to make the hair on the back of your neck stand.
No.
But here's the problem: we never really let it reset. Yep. We put a Band-Aid on it. If there's people out there that think that they really fixed 2008, call my company. I want to get a whole new set of perspective here. I've not yet come across anybody in all my talks that somebody actually can factually say, we reset this thing and fixed this thing in 2008. They didn't. They Band-Aided it, and they made it actually worse by printing a whole bunch of money called quantitative easing, and now we're paying for that. That's what this is all about. They're trying to pull away the money, the cheap money, the punch bowl, and get interest rates back to normal because they went to artificial rates. So the pendulum is swaying from one huge side of the direction to the other huge side, and they're just creating a whole other bubble after the bubble they created before. This is the fault of the Fed and the government, in my opinion, if you want to blame. And, people that create this environment was created for, that we sense that we're led to believe that this is normal when it's not normal. Artificially low interest rates where you can flip your house and make money in a month, and houses are going up 35-40% a year. That's not normal, but that's what was led to believe was normal. And now they're thinking this is normal, that we should have had another stock market boom like we had last year with corporate earnings. It's not normal. And so when the abnormal comes out, we got to go and break this thing down and have a crash of some sort or a recession. But this time it's going to be bigger than 2008 because it's based around government and sovereign debt. That's the big problem that's coming up.
Well, no, it's funny how you say that because I agree with you. I mean, we look at the stuff, we throw Band-Aids on stuff, we have no long-term goals. You're going to laugh at the simplicity of this, but I remember way back in the 60s, late 60s, and sitting on a station wagon with my Uncle Bill, very, very wise man even at the time, and we had just gone to McDonald's, and that was a treat. Once a week we would go to McDonald's and sit on the back of the station wagon eating, and he'd say, the problem with your generation is they want it now, and this is not going to work out well for you guys. I remember him saying that, and look at me. I remember that all those years, and I'm watching what's happening with credit cards in the market and other things are going. He was so right. My generation and our kids want it now. They want the 6-minute hamburger from Jack in the Box or wherever, right?
I see the same thing. They said those things when I was in my teens, and I was pretty patient, I thought, and compared to most of my peers at the time, I'm very conservative. And I grew up that way on a farm, and I'm significantly more conservative than what I'm seeing this generation. And, I'm not putting it down, but yeah, there is that element there.
Yeah.
And unfortunately, it's woven into society in the American culture. And we think, debt and credit is
normal.
A way of living. It's normal. But, you got to pay the bill. And when you can't pay the bill because the economic environment has changed towards the worse, it makes it challenging to pay the bill. And that's where we're going. I mean, let's put this into perspective. The global debt is $257 trillion, the highest it's ever been.
How many zeros is that?
How many what?
How many zeros is that?
A whole bunch. Around the world.
No. I mean, people don't realize. I mean, they're just numbers. You know what I'm saying? And they are just numbers. Until you have to cut the check for them. We'll be back a lot more on that and your finances and what this all means to you after the break. I'm Joe Messina, your host. This is The Real Side. We're back at it. I don't want to waste any time because he is wound up. David Fischer joins me, CEO of Landmark Capital, and we've been talking about what's going on in the market and where people are at, and truly, I was talking to David during the break, and I think I really poked him big, and I said, David, the trillion doesn't mean anything anymore. 10 years ago, if we had said the government or there was $1.2 trillion in credit card debt, we would have gone, oh my God, trillion? What is it? Oh my God, I can't even imagine that kind of money. Now, because we've spoken about billions and trillions so much, It's just another number on a piece of paper. Why is this dangerous, David? And can the banks handle a recession at those kind of numbers? And where do precious metals fit in?
You know, $1 trillion is a lot of money. Let's put it in perspective. When President Reagan was in office, the debt was $550 billion. And everyone go, oh, that's a heck of a lot of debt for the United States. But the GDP was 34%. In other words, the money of revenue coming in to pay that debt, we could manage $550 billion. Here we are now, $21 trillion at 107% GDP. We can't manage the debt. We're going further into the debt. This is why the IMF is issuing a warning about the United States not getting out of debt when we're in an economic boom cycle on low unemployment. We should be paying the debt down. The Congressional Budget Office fires out a big warning saying the United States cannot manage its debt. We're having huge budget deficits now, are reaching $1 trillion more a year. Now we're overspending $1 trillion. And put it into perspective, Joe, yes, I am wound up. There's $257 trillion of global debt. And of that debt, $50 trillion has been added the last 10 years. And of that $50 trillion, $21 trillion was added just last year of the $50 trillion. So what does that say? On a chart, the debt is escalating at a huge, rapid pace, going straight up. And this is the dumbest thing we could be doing. We are literally hanging ourselves as a world when it comes to debt.
Wow.
So, and
I
can go on. I mean, this is not even all the unfunded liabilities even factored into this, which is all the United States has $104 trillion of just that alone.
Okay, here's the reality: if the bank doesn't have enough assets, if you would, or they're not capitalized enough to handle a recession, what does that mean to the bank? And secondly, what does that mean to Joe Depositor?
Well, first of all, the banks have come a long ways in getting more capitalized. Right now, I think they're fully capitalized, not for this type of thing that I think we're going to have happen in 2020, a major reset. But if we went through 2008 again, we would see some banks go under, yes, and the FDIC would come and do all that thing. And bail them out until the new bank came along and make depositors whole.
Right.
But this time, unfortunately, the government's moving away the buffers, and they're trying to create they already passed legislation, Senate Bill 2155, which allows banks to not have to have large cash holdings on hand. It also allows them not to have an annual stress test to see how they are doing, and they're having if they go through financial stress. And they also took away what you call the living wills, that when they go through a collapse, how they unwind from other banks so they don't pull the other banks under and the other financial institutions. Those three things are being taken away of the requirements if this bill gets signed by President Trump. And there's also another some legislation that is happening on 8 major banks not having to have major cash holdings. So there's a move, unfortunately, within our Congress that says, let's go back to the old ways before 2008 and let's have very low amount of cash. Because here's the deal. They want banks to put that money to work so they can stimulate the economy. And I get that. But you got to still have cash on hand for that rainy day. You know the story of the 7 cows that were skinny in the Bible that Joseph interpreted the king's dream. A famine is coming, and the big the 7 skinny cows gobbled up and ate the 7 fat cows, representing, we're going to have a famine, but for the 7 years of great prosperity, put away money, put away grain for the 7 years of famine. We're not doing that as a country. We're not doing that as individuals. We're not doing that as a world.
But David,
and the banks, they're taking away those requirements.
You just hit on something that was, again, my uncle talking about wanting it now, and 2 generations of people being brought up that credit cards are okay and loans are okay and over-encumbering yourself is okay. Those people have moved into Congress. Those people have moved into positions of authority. And that's why we're going down this road. I mean, I don't know how you reset this. I don't know how you can actually reset when the mindset in Congress is the money is there. It's just 30 or 40 years out.
Well, there's no way that you and I, as individuals, can influence it. We voted we keep voting for this to be done, but yet nothing continues to happen, and we just keep going down this road that I've described. And the day of reckoning is coming. So this is the time you become your own banker. This is the time you become your own financier. This is the time you get your house in order financially. I'm saying with a passion, there is a time. I'm not a doomsdayer. I've said when the times were good, I told you the times were going to be good. So I say it how I see it moving, and there's lots of other people who have nothing to do with gold are saying the same things that I'm saying. The world is not going to collapse and crash and the dollar's going away. That's not what's going to happen, but we're going to go through a major reset. We might even have a change of a type of currency where countries might go back to partially backing their currency by gold. I hope that happens. It wouldn't be good for my industry and myself, but it'd be really good for the countries because it would create you can only pay what you can afford to buy type of deal. So, and you can't just create money out of thin air. So I think there's this movement underlining. I think we're years away from it, but the markets and the environment might force this to come to the forefront. But if that doesn't happen, and I don't think it will, it's my wishful thinking a little bit there, you got to prepare on your own. That now's the time to be putting some money away and getting your credit card bills paid down. Make sure you're not in a variable loan. Make sure that you can handle your money. You have you put 3 to 6 months of money away in cash, and make sure that you also have some precious metals there and some money outside the system. Because if this thing goes really bad, this time they can bail into your accounts. They couldn't do that last time in 2008, but there's laws that now have been passed. I have a white paper on it. I don't talk about this much anymore because it hasn't been on the front burner. It's been on the back burner, but I think it's going to start coming to the front burner here. I'm seeing some signs of it. Just get prepared. Put away some money during this good time and get your bills under control and your debt structure under control. Now is the time to be doing that, not taking on more debt and making the same mistakes we made in 2005, 6, and 7.
Yeah, it is. For some people, you were brought up differently, but for some people in my generation, in my world, it was, well, you want that TV, get it now, pay it out. So this is not that weird to them. And I've talked to some people who really believe that the government's got more money than they know what to do with. You know what I'm saying? So anyway, I don't want to eat up the rest of your time and all this other stuff. Real quick, here's my rapid fire to you. Bitcoin. You had once said it's probably here to stay, but it's really nothing to think about. You still think it's going to be around for a long time? Because it just really.
Yes.
Okay.
It's going to be here to stay. It's not going away. It just might not be traded that often.
Yeah, it doesn't look
like the volume of it is down.
Way down. Yep.
So the market is down, the volume is down, and it might not be broad based. It might just be used as another way of investing, which obviously I think is a poor investment right now. But it's very volatile, and it's not mainstream. I don't think it will become mainstream. There's people that totally differ with This is my opinion, and this is why it dropped in half.
All right, real quick, school loans. I mean, school loans for students are out of control. Is the government going to have to reset? Is it going to have to do something with those?
The government doesn't have to do something with those. This sounds like a Bernie Sanders come to the rescue. I'm not a Bernie Sanders supporter. Here this starts being political. I feel very bad for people that have to get a student loan. I believe in education. I believe in making bettering of yourself. And unfortunately, if there's no other way to do it but get a government loan to do it, I'm then for it. I think the government needs to make the interest payments ultra ridiculously low, because the government, it doesn't cost the government to make money anyway anymore. They just issue it out of thin air through the Fed by calling up the Treasury and saying, make some more. So I think interest rates should be artificially low and set at artificially low rates for loans. And but should there be a government program? I'm never for subsidization.
Easy for him to say. Anyway, we get more information about Landmark
capital, you want to head over to the website, therealside.com. It's therealside.com. You know, I really appreciate you guys being with me. I appreciate the time that you're spending with us on the air and in the chat room and texting and tweeting. God bless. Have a great rest of the day. We'll be here the rest of the week. Hopefully you will too.